Hey everyone, it's time for our next edition here, the June edition of the 20-minute market breakdown. I'm Brian Bogner, joined along with Greg Towner, and we're going to take the next 20 minutes and share with you our thoughts, comments, and about the markets, economy, all these fun things that were happening right now. But you know what's happening right now? It's summertime. I think it's officially summer. I mean, I know it starts after Memorial Day, but I just feel like now we're kind of in the middle of it and it's feeling like summer. And I got to say, we have been very blessed here in South Carolina up until this week. Now we have a 10-day period here where it's been raining nonstop. But before that, we were having 60-degree nights, maybe topping out around 80 degrees. It has just been a wonderful, beautiful, nice weather summer so far. I've been very thankful and very grateful for that. We are getting some much needed rain, probably a little more than we need, but it just seems like a very mild summer so far. I know the heat can be a lot, but I'm very, very thankful for that. Greg, how you doing?
I'm doing great. I agree with all that. We made it the furthest ever, I think, before turning on our air conditioning. So it's a good long spring.
Yeah.
But
Awesome.
I'm excited about what we have to talk about today. It seems like our recent conversations have been around kind of noisy topics that were happening, debt ceiling, bank crisis, these kind of short-term things that, we of course needed to address, but we knew they'd probably be short-term in nature. And today we're going to get an opportunity to talk about some topics that we think are a little bit longer term in nature. So we like that.
Yeah, actually, and what I would say, if you're listening to this podcast, this is the one you may want to take a few notes on or really listen in intently. Okay. I know when we talk about these short-term things, everybody gets excited about it because that's what's in the media. And, oh my gosh, what do you have to say about it? But 9 times out of 10, a month later, nobody's going to be talking about that thing anymore. So what everybody's usually talking about, a month later, they're not talking about it. And we can give you examples. And that might be just another podcast we do and showing examples and reasons for that, because I think it's really important. But, read a quote recently from a very big money management firm. And it said, we're having a non-recession recession. And what I mean by that is all of us in this room, and I'm just reading the quote here, all of us in this room are going to feel a recession because we basically were the beneficiaries of a decade of money printing to the tune of $8 trillion, not 8 billion, not 800 billion, $8 trillion. That's a little my emphasis I'm adding there. That's not actually in the quote. However, fundamentally, we're in a normal period of time. What was abnormal is what happened for the past 10 years. And you've been hearing us say this for a while now, is that we are just returning to normal. It feels like, oh my gosh, this is happening or this is slowing down and whatnot. But really what is happening is things are starting to normalize again. And that's why we say what worked the last 10 years is likely not going to work the next 10 years, because the last 10 years was actually the abnormal. And you got to be really careful right now if you think, well, let's get back to the last 10, because that was the outlier. So let's start talking about that. And Greg, let's talk about a little bit about the last 10 years and what was what was out of whack.
Yeah, there was certainly a lot of things abnormal. I mean, we could really go back even more to 10 years, basically to the end of the financial crisis. And since then, essentially every asset has gone up in price.
Right.
Stocks have had a huge run, real estate, bonds have gone up in price, which of course means yields lower. Crypto, sports cards, art, you name it, everything went up in price for a decade or more. Now, of course, there was corrections along the way. There always are, but I think those corrections were very brief in nature most of the time. So people got accustomed to things going up. Corrections very brief. There weren't these long sustained either down markets or even sideways markets. And most of the reason for all of that is because the tremendous amount of liquidity that was in all of the investable markets in the form of low interest rates, the Fed keeping their rates low, the Fed performing quantitative easing, a variety of, fiscal stimulus, whether it be legislative spending or tax cuts or what have you. All of these things pushed assets higher. We also, over the past, decade plus until the pandemic, had much below average inflation. Inflation for a long period was about 2%. If you go back over long history.
Right.
It's about 3%.
Right.
So then inflation hit in the pandemic, and it felt much more different. So
Well, yeah, we had the pandemic, right? I mean,
yeah,
inflation was still low at that time. And then, it's like, if, at the end of any move, there's usually what we call like a blow off top. There's like this thing
right,
that just kind of blows everything out.
that's
We
right,
had the pandemic. We had like the mother of all liquidity events during the pandemic. We had this big blow off top, right?
right,
And that was in 20 into 21. And then 2022 hit. Okay. Right.
yeah,
And
yeah,
then what started happening? All that liquidity started getting yanked away, and interest rates started going up, and the game changed like that. And 22, what do we see? All right, asset prices started coming down, things started changing. Everybody started going, wait a minute, what's going on here? So let's talk about 22 into 23 and kind of this, which I still feel we're in this transitionary period right now over the last 10 years.
yeah. I agree. We're definitely still transitioning, normalizing. If we go back to that period last year where the market started to weaken, and economists started to get really worried about the economy, everybody assumed we'd be in a recession by now. An actual true recession.
Mhm.
But when we look at the data, if anything, the economy is maybe even strengthening a little, certainly staying firm. Job market's very strong. I saw a quote this week from General Electric, large industrial company, that said they see no sign of economic softening. I mean, you can certainly find signs out there of something softening, of course. So even though the economy is staying firm, you look at typical consumer sentiment index or surveys of consumers around the economy, they're largely negative.
Right.
And certainly some of this is political related. At any point, half the people are going to be upset about something these days,
Right.
right?
Right.
But really, I think much of it boils down to, people, consumers, investors got used to the abnormal last decade of high growth, low inflation. So they kind of became anchored to that view. So even though most people have a job and, asset levels are still fairly high, a lot of people might kind of feel like we're in or near a recession, when in reality, it's just this normalization process that we've been talking about and are going through now, and may continue to go through for a bit of time.
Yeah, and I'm just going to add a little caveat to that as well about why consumer sentiment is down and things like that. And you've heard this say us a million times, and we will probably sound like a broken record, but avoid the noise. There is so much noise right now about the negativity, and negativity is what sells. Positive stuff does not sell and does not get more clicks. And how I know this is my clients don't email me or text me or contact me asking me about articles that are positive, because they're not out there. They're always, oh my gosh, I read this the other day that this thing's going to happen, and we're on the edge of economic collapse. And I get these constantly from folks, and
Right.
I don't, it's to the point. I don't want to say like, stop reading this stuff. Stop. Like, what are you reading? Where are you getting this? What's your source? How are you looking at this? But that, I really believe, is what is just dripping on people over and over and over again, right? Because we have these things, we have these phones, and I know I'm sounding a little preachy here, but it's important. It's so important because media does not have your best interest in mind, and I think that's one of the reasons why people feel, right, we're going on vacations and we're doing stuff, but we don't feel great about it because we're getting inundated with this other stuff. So I'll stop there. I'm getting off my soapbox. I'm sorry. I had to go down this road. It's just because we are inundated with this
Yeah.
constantly here. So let's change focus here a little bit. So we've talked about the last 10 years. We've talked about this past couple of years in this transition. What do we need to be focused on going forward? What do we need to be looking at?
Yeah, I mean, so starting off from the investment perspective, I mean, we think, again, and we love this, price and what you pay is going to matter again, and in terms of value. And
Mhm.
when we talk about value, we're not necessarily talking about, people talk about, value stocks or growth stocks or what have you. I mean, that's always been a little bit hard to determine, and it's actually getting even harder to categorize stocks. I mean, if you look at some of the value indexes now, they have like the big, mega cap technology names in there, and then some of
Right.
the growth
Right.
indexes have energy in there. I mean, it's all mixed up, and some
Right.
are here or there. So we're more focused on, are you getting value for what you're buying, whether it's a stock, a
Mhm.
home, a business, what have you. Focus more on value and the fundamentals, meaning what cash flow is being generated, you
Right.
expect to be generated, whether it be
Right.
rents, dividends, what have you. It's no longer about just buying something because you think it might go up and you can sell it to the next person for a higher price.
Yeah.
You want to have actual fundamental values behind it going forward.
Right. Yeah. And I think another area, asset class, I don't think I know to be thinking about going forward, is fixed income.
Yeah.
To your point, Greg, earlier about the last 10 years where interest rates were just in the dumps and it really wasn't providing any real value or return, that has certainly changed. And interest rates now are beefy. There's some meat on the bone there. They've got, there's some areas there that are actually outpacing inflation and providing a decent return. And that's we believe that more and more now it's probably needs to be a little bit part of your, it depends on where you're at in life and things like that, but part of your portfolio.
Yeah, absolutely. And tied somewhat with those interest rates and fixed income is the real estate market.
Yeah.
They're driven a lot by interest rates. And before, when everything was going up and interest rates were super low, it seemed like real estate all across the country was just going higher.
Right.
We're starting to see that be differentiated, and we think it's going to get back to, historically real estate was more local. What is happening in your, is the economy good in your local market, whether demographics, people moving there, leaving there, et cetera. So we think real estate can still remain a healthy asset class in select markets. It's certainly getting expensive in a lot of places. That's a risk, but there's also very low inventories, particularly when we're referring to residential real estate. So we think that's something that's going to be different going forward. Instead of just all real estate is good and it's all going up, it's going to be a lot more localized geographically.
Location, 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 right?
I think I've heard that before. Yeah. So, what else is going to be important going forward? We've said this a number of times, but we think inflation is going to settle in at a higher rate than it had been for, say, the past decade. So let's kind of break that apart a little bit. Over the last couple of years, people were hit with this really high inflation, much higher than normal. It's obviously was painful for all. But I think it was even more painful because the decade before, inflation was only around 2%. Historically, inflation was 3% or more. So we think it's going to have to settle in back with something maybe with a 3 handle on it. Ultimately, it's keeping to come down now, but we'll settle in higher. Some of the reasons for that, deglobalization. What does that big word mean? Basically, it means that, we're moving a lot of manufacturing out of the areas of, say, Southeast Asia that were cheap to make things back to the US where it's more expensive to make things. So it's going to be more expensive from that perspective. And also a lot of commodities have tight supply and demand dynamics. So there could be periods where commodity prices go up. So ultimately, we think inflation has to settle in at a little bit higher than the norm. Diversification, we think, is going to be important going forward. Of course, you could always say that, but one reason that we think it's going to be even more important, and getting back to the normal of things, is this whole theme around longevity. People are living longer, medicine, taking care of yourself. If artificial intelligence happens to be a miracle, there's some that argue people could live a lot longer, perhaps.
Right.
So if that's the case, I think diversification and non-correlated assets for people that are living a longer retirement are going to be important so that they have lower volatility. They're less apt to make some of those critical mistakes and can kind of go through and enjoy that long period that they hopefully have in retirement. So diversification is something that we think is going to be incredibly important going forward.
And if you think about this longevity theme, which I think is a big deal, like people are just, you're right, people are just living longer. And that, we've looked at all the studies over time, and the longer time frame that you have, assets, especially if you're looking at stocks and a good diversified portfolio, it's the longer time frame you have, the less probability of that being a negative or, return or something along those lines. So if we think about, longer periods of time, yes, being diversified is important, but probably even more so is having a financial plan, having a plan in place to make sure that over that time frame, what are the milestones and the things that you want to accomplish and hit over that time, and being able to fund those things and not outlive your money. Having that plan is more important than, well, did I outperform the S&P 500 over the last 6 months, or last year? That,
Right.
those conversations, people still want to have them. They're becoming more and more irrelevant. It's just not a relevant thing anymore. It's about where do you want to be? Who do you want to be with? And what do you want to be doing? And,
Yeah.
and what do we need to do to get you there?
Yeah.
Those conversations are what matter. Not that I outperformed the S&P 500 over last year. So that's speculation. Financial planning is a matter. And I'm going to make a little advertisement here. If you need an update on your plan or anything like that, give us a call. You know where to reach us. We have very robust planning tools here, and we're happy to help you and walk through that with you. So, all right. So we're focusing on some things here to go forward. And these, everything we've talked about, whether it's cash flow, value, fixed income, all these kind of new things as we kind of get back to normal here.
Right.
But there's things, Greg, that just don't ever change, are there? No matter what's going on in the world, no matter what season or cycle or what we're in, there's just things that don't change. What are they?
Yeah. Coming back to one of our all-time favorite topics here, the emotions. So fear and greed, unfortunately, will always be a factor in investing. That's why we talk about it so much.
Yeah.
Everybody sees it all the time. It's very hard to avoid, particularly as you talked about with all the noise out there. So to us, critical function going forward is to continue to build portfolios that we think are less likely to create volatility, less likely to create reasons for investors to be emotional, and for us to keep hammering home, focus on the long term, focus on your financial plan. Don't focus on the short-term noise, because fear and greed will destroy any financial plan that you might have quicker than you could imagine. So unfortunately, we don't think those things will change, but we're going to do our best to reduce the likelihood that people are susceptible to them.
Right. Well, good. Well, I think in closing here on this is that, again, we're returning back to normal. And any time you get extended or things kind of really kind of blow up to the upside and you've got to revert back to the mean, it's not a fun journey.
Right.
But this too will end. And again, I say it's not a fun journey and it feels that way, but the reality is, look, you go to any restaurant, you go to any place right now, especially traveling experiences, stuff, where people they're out and about, they're spending money. So it's this weird thing, like everyone mentally has this recession thing going on, but what are they actually doing and how they're spending their money is a whole different thing. So, we're in this transitionary period. It's going to settle out. It's not to say we won't have a recession here at some point. But for right now, we just don't see it. And again, I think this is a good thing that's happening, especially long term, as we kind of get back to normal. It's healthier, right? It's a healthier thing, right? We're not eating sugar and getting sugar high all the time. We're, it's eating our veggies and having a much more healthier environment. So,
yeah.
All right. So we always like to end this podcast with some closing recommendations. Greg, what do you got for us this week?
I've got a couple things. So recently Netflix put out a new documentary called Unchained. It follows last year's Tour de France. I think people might be aware from past recommendations I've made and comments I've made that I'm a big fan of Tour de France. My wife and I both like to watch that together. And the documentary is really good. It shows a lot of behind the scenes of the teams and what was happening going on in last year's tour, and it just kind of ramps you up getting ready for this year's tour starting July 1st. And if nothing else, if you enjoy amazing scenery, watch the tour for some of the most amazing scenery, videography you could ever see. And then who knows, maybe you'll get into the race itself. But
I think these sports documentaries in general are just great. I mean, I'm a big fan of the Formula One. What is it, Drive to Survive?
Yeah,
I think
this was actually done, I believe, by the same people that did that.
Yeah, I love that. And if anything, it's taken that sports people are following that now that never even cared about it before. They have this one. I think they did one on golf recently as well. So they do a really good job on these documentaries. Highly recommend it. My recommendation is on something that probably has been getting talked about a ton right now. this whole thing about artificial intelligence, AI, right?
Right.
Again, we talk about noise. If there's noise in one particular area right now, it's about this AI thing without a doubt. But we're the belief here that this AI artificial thing is real. It's not like a fad or a flash in the pan or something. It is a real thing. Now, how it affects everybody, I don't think anybody has any clue yet. And anything you read at this point is pure subjective guessing at this point. But I do know there's actually great tools out there you can start taking advantage of today. And I know the number one tool that most people are using right now is that Chat GPT. I hate the name of it. Clearly a marketer did not come up with this name, because most people say Chat GBT, but it's Chat GPT. I read a stat the other day, only 14% of Americans, people here in the United States, have used Chat GPT. Now there's 350 or 330 million people. So 14% is pretty big group of folks, but it's still a very small group. And I would just encourage you, if you can, just fool around with it. Get yourself familiar with it. Don't be afraid of it. It's like anything else. It's something new. It's something scary. We've seen the movies. We've seen Terminator. We've seen The Matrix, right? Where's this thing going to all end up? Are they going to kill the humans? No, look, I don't know. Who knows, right? But typically in any new thing, and what I do is I like to go back to the .com era. You have a mania. I mean, the mania starts right back in the late 90s, early 2000s. If you put .com on the name of something, it just got crazy and blown up and everything was going great. And then, what happened is kind of reality started to set in and you had a big correction. And then you have the next cycle, I call it adoption, or, the real growth cycle. And I have a feeling this is going to play out the same way. There's all this crazy stuff about AI and whatever. Reality is going to kind of set in, and then we're going to really see how this thing grows and affects and what. But it's here to stay. It's not going away. And I would just encourage you to embrace it. Might be too hard of a word, but at least be familiar with it. And I think it's just a great way right now to do it. It's it's free. They just need an email address. You just give them an email address, and I'm sure we've all got those junky email addresses we use to sign up for coupons or whatever discounts and things like that. Throw them an email address, get a sign in, and check it out, and just start becoming familiar with it. So on that note, we'll go ahead and end it. I want to thank you so much for watching today. And as always, we appreciate you. If you have any questions, please reach out to us, call us, email us. You know where we're at here at Parallel, and we look forward to talking to you again real soon. Thanks so much for listening.